spoke with the founder and CEO of Doubleline Capital, CEO Jeffrey Gundlach. Now we want to bring you this exclusive. He's called the Bond King. He was one of the first to predict that Donald Trump would become the president. And now Gundlach is revealing his thoughts on the markets in the Trump era. I sat down with Gundlach and first asked him whether or not we're at a post-Trump market bubble. Listen.
There's a lot of anticipation that's there for sure. I think the weaker dollar this year has been something that's you can point to that's sensible in helping. It's like the S&P 500. The dollar's down about 10%, and it was getting kind of difficult with the dollar having rallied so much from 2011, even from 2014 into 2015 and 16. So that's helped. But the valuation of the market is high, and you can sort of get down with it if you have zero interest rates, which you had for a number of years, but that's not there anymore. Interest rates have been rising. The Fed wants to raise rates again. They want to raise them 3 times next year. That's their base case plan. We've got quantitative tightening, which is a phrase nobody uses because it doesn't sound good. Quantitative easing was a fun thing to say, but tightening is what we're doing with the flip side of letting bonds mature and finally borrow the money from the budget deficits from 11 to 14.
Yeah, and this incredible unwinding of the balance sheet.
Yeah,
how easy is that going to be?
Well, they're willing to let $30 billion of treasuries roll off per month. There'll be some months when there aren't that many, so it'll be less than $360 billion for the year in treasuries. But there'll still be, a couple $100 billion, which is significant. Budget deficit could go up. With the tax plan probably not being revenue neutral, if you cut taxes, I mean, when you have a tax plan, your assumption is 3 or even 4% economic growth is what balances this to be a
that's how
deficit.
It's going to be paid for.
Well, there's that growth is a big if. And I don't think the math works to get you to 4% economic growth. You could probably get to 3 for some period of time if you got lucky. But
you don't see 4% in the next couple of years.
You would get a quarter maybe, but no, you're not going to get year-over-year growth. I don't think of 4% real. And the deficit also is slated to expand anyway because of the demographics of the entitlement plans. It's not like it was for the past 4 or 5 years, where the deficit, nobody talked about the deficit anymore.
Yeah.
Remember we were also worried in 2011, the government's being shut down, we can't get a budget, Greece is collapsing, and all this debt to GDP is going to be the end of us. Well, that's become a sidebar story because the deficit was so stable for all those years. But we're starting to get into that compounding curve again with Medicare, Medicaid, Social Security, whatever's going to be left of Obamacare.
Nobody focuses on the fact that these programs are going broke.
Well, there's deficit could, under the wrong set of circumstances, the deficit could easily get up to 6-8% of GDP again, because maybe we'll have a recession in the next 5 years. I mean, it wouldn't be that strange. It's been 8 years of an economic cycle so far.
Maybe we see the beginning of a recession second half of 18.
Right now, I can't find a recession anywhere. Leading indicators are great. Okay. Unemployment is low. Optimism is very high.
Well, that's October 2017.
But the visibility on these indicators is not more than 6 months. These things can change pretty dramatically over even a 3 or 4 month period. So with the Fed tightening, if they get into this mode where they just keep doing it unless the data gets worse, by the time the data does get worse, it'll be like
they blew it.
It's too late.
Then they blew it again.
Yeah. So you're in that mode of risk.
How do you allocate capital with all of these unknowns? Tell us how you want to position the funds.
Well, Well, we start out with bonds. We've been defensive on bonds since we took a look at down near 2% on the 10-year Treasury. We felt the environment seemed awfully similar to July of 2016 when the 10-year went all the way down to 132, and the narrative was rates will never rise again in my lifetime. Never means imminent in the investment business. Never means imminent.
I'll remember that next time.
So the rates rose, and I think rates have been rising begrudgingly lately. But I think we could see another leg up in yield, so we want to be defensive there. I think there's a great overbelief in junky credit because it's done well. It's one of those classic things that people love buying high. So we've had a huge
it'll continue
run.
to do well.
Well,
like housing in 2007.
Right, and similar to housing 2007, one of my worst market timer clients called us up saying they wanted to do nothing but leverage up junky credit. And I said, it's a little late for that. Do you know that high-yield bonds, double B junk bonds in Europe, the index, yields the same as the U.S. Treasury market?
Wow.
Junk bonds.
No, I didn't know that. That's
hard
incredible.
to believe.
Yeah, it is.
Yeah. About 2%. So that tells you that something is very, very strange. And, junk bond spreads are tight. I don't really like that very much. I'd vastly prefer to play currencies. I don't think the dollar is going to. I think dollar goes up short term.
But then you think long term it's down.
The next big move, I think, is down. And I think that's because the Fed, the expectations that the Fed is going to get up to 3% on the Fed funds rate by like 2019, I think that expectation is going to be dashed. And when the expectations for the Fed out 2 or 3 years get easier, the dollar tends to go down.
Is there anything you would buy in equities?
I like non-U.S. equities much better than U.S. equities. We've been positioned much more heavily than we are on average in non-U.S. equities, particularly emerging markets. I'm not a big fan of China. You might want to take that out of there because it's just, I don't hate it. It's just unanalyzable. One day it'll blow up. I mean, I know the bear case. It sounds terribly convincing to me, but it sounded great 5 years ago, too. So you have to wait for something to change there. But I really like, for a really substantial, kind of permanent part of a portfolio, I like India. There's an ETF, INDA, that I've been recommending for a while now. It's done super well. I don't love the trade location after it's done well, but you got to see the big picture here. This is a 30-year type of an investment theme, that the opening of that economy, I think their GDP will grow 10x.